Hi, welcome to the webinar. This is Ed Pagecroft, founder of stockopedia.com here. This is about the NAPS portfolio that I've been writing about on the site for several years. And the essence of it is how to run a potentially market-beating systematic stock portfolio in only a few hours per year. And doing this without relying on any of the traditional ways of making investing decisions, such as relying on broker recommendations, bulletin board rumors, or even a deep sustained analysis of company accounting or management, which is something we do behind the scenes. I call this the NAPS portfolio. I'll be explaining why. Before we get started, I wanted to say who this is for. This is really for several groups of people. If there are novice investors or beginners or those for looking for a less time-consuming way of investing, you'll learn how to build a portfolio of shares that historically has generated higher returns at lower volatility than the market using some of the Stockopedia tools. For more experienced investors and long-term subscribers, I'll be going over some of the historical NAPS performance results year to date, and also reinforcing some key questions I've received on factor investing, diversification, rebalancing, and more. This does build on previous webinar I've done on this topic, so you might see some familiar material. I also wanted to stress to international subscribers, of whom we now have many in Australia, America, etc., Asia, that while I'll be showing that and focusing on the UK results, the lessons of factor investing, upon which this is all based on, are applicable globally. So some regions perform more strongly than others, but these principles tend to matter and they tend to be pervasive around the world. Before we get started, I just wanted to give a quick disclaimer. We're very much a DIY investing portal. We have lots of self-directed investors that use the site. We make all our data and analysis available for your own decision making. Just remember to, if you don't know what you're doing, to get financial advice. Shares go up as well as down, and past performance, of which there's a lot in this webinar, is not necessarily a guide to future performance. Markets can be cyclical. So this is some of the things we're going to be talking about today on the agenda. The webinar will last about an hour, possibly a bit longer. I'll be going through some of the background behind the NAPS and factor investing and my own reason why I care so much about it. I'll also give you a portfolio review of the NAPS, looking at some of the performance historically and year to date, and then go into some of the philosophy behind this method and some of the ways that we build the strategy. Then I'm going to give you a demonstration of how I've constructed the NAPS on the site. As this is, I'm recording this after the live webinar, there won't be any Q&A at the end, but I will try and weave in some of the questions I've received into the presentation. So this is me. I'm Ed Pagecroft. I'm a chartered financial analyst, co-founder, CEO at Stockopedia. I used to be a wealth manager after I left university. I had a couple of jobs and then I ended up in Goldman Sachs private clients department. So I was originally a wealth manager, but I didn't want to stay a wealth manager. I wanted to do something else, something more creative. But actually what happened after I left Goldman's was I was running my own portfolio and I was running my own investments. And my portfolio had quadrupled over something like 4 years. And I found myself in 2007 with a portfolio that was so concentrated in 5 stocks, all in 1 or 2 sectors. And I had absolute conviction that my portfolio was going to go up and at least double by Christmas. And there was one, my biggest holding, which was about 40% of my portfolio, that I told my wife would quintuple by Christmas. So what actually happened was that biggest holding halved, and the global financial crisis gradually sort of unfolded over the next year. Thankfully, I managed to get out without having too much devastation, but it was still hugely painful and led to a massive reassessment of my investment process. Now, after this very painful experience, I then spent years going over the academic research into investing and also into why people make big money mistakes. And I found that actually this kind of behavior, that I'd sort of fallen into this trap of thinking I was too clever for my own good, this trap of overconfidence was massively widespread amongst private investors. In fact, the studies of 80,000 private investors in America and all around the world that show a remarkable tendency for almost everyone to fall into these exact same traps. So anyway, in my research, and I'd always been a very data-driven guy, I consolidated all my thinking around factor investing. And this is a very little known way of investing that seemed to offer consistently higher returns at lower risk, but also in a diversified fashion. So rather than actually going straight for like a concentrated portfolio that most investors do, I realized that actually I could take a more diversified approach, cut my attachment to the stocks that I held and my attachment to the narratives that were unfolding in these stocks, and actually do just as well or possibly even better. So this was very much the key I'd been looking for, controlling the emotional side of investing. But the issue to do it required a massive amount of data and computational power. But I thought maybe if we actually could club together enough private investors to buy the data and sort of pay for the computation, that we could sort of do it collectively together. So that was really the founding principle of stockopedia.com. So a bit deeper into factor investing, this is just some comments from BlackRock's website, and I wanted to read some of these out. So this idea of factor investing is to focus on factors that are broad, persistent forces that have been historically the drivers of returns in not only stocks, but bonds and other assets. And our whole ranking system at Stockopedia is based on these factors that I'll be going into in a little bit more depth later. But factor investing really leverages advances in data and technology to seek out these historical return drivers in portfolios. And so if you can understand how these factors work, it can help you capture the potential for excess return and reduce risk. And so this is really very much what we're doing and what we're trying to do at Stockopedia. And this is what makes it all possible. It makes possible the kind of portfolios that I'm going to be describing, and specifically the NAPS portfolio process. So just to show you the impact of this, this is basically the FTSE All-Share, which is the benchmark in the UK. Now, since I launched this NAPS portfolio live on the website, it's been running about 2.5 years now, and it's a 20 stock portfolio, very diversified. Now that is the FTSE All-Share, which you think would be a proxy for the general returns available in the stock market. Whereas the NAPS portfolio has returned way more. So you've got a massive return differential here. That's a 78% return up to end of June 2017. And actually it's gone up even more in the last few weeks, up to more like 85% return. So it's going along at more than a 25% annualized return in what has been a fairly moderate period for stocks. The FTSE All-Shares has risen about 18% in that time. And I think it shows you some of the how this method is generating additional sort of returns in the market. Of course, we haven't had a terrible bear market in this period, but we can see that during this kind of flat or sometimes down, sometimes rising market, it's been quite consistent. Now, it's important to stress how this was done. It was done with no broker, newsletter, or press tips read. No bulletin boards trawled, no company managers met at exhibitions, and no company accounts or results analysed. Of course, we do analyse the accounts using the Stockopedia systems, but the process I did to put this portfolio together has literally taken me an hour or two a year, using and leveraging all the work we're doing at Stockopedia behind the scenes. So this whole process is very much based on the principles of factor investing. In essence, and this is very much an implementation of how we've done this, the selection rules are very, very simple, although they've evolved a little bit over time. Ranking the market by descending stock rank, and I'll be explaining the stock rank in a minute. Excluding very small and hard to trade shares. And, you know, having been burned in 2007, although you can make a lot of money in very small micro caps, I like to go and invest in slightly larger stocks because there is nothing worse than being stuck in poor liquidity stocks in a downturn market that you just can't get out of. So I look for stocks that have a larger than 50 million market cap and a bid to ask spread of less than 5%. If you don't know what a bid ask spread is, it's the difference between the buy price and the sell price. Where the buy price is the ask price where you buy your shares, and the bid is the sell price, and then the bid tends to be lower. So try and look for stocks that tend to be higher, easier to trade, tend to have what are called tighter spreads. So there is not such an expense or difference between the buy price and the sell price. And then originally we have a sector classification system at Stockopedia which has 10 sectors, and each sector can be financials or energy or basic materials or consumer cyclicals, different kind of categories of company in each, and selecting 2 stocks from each of these 10 sectors to make a 20 stock portfolio. And And this is not a very highly concentrated portfolio. If you look at those returns, they've been done using a 20 stock portfolio that a lot of people would say is a very diversified portfolio. There's a lot of, and as I'll be explaining later, there's a bit of a myth that you need to concentrate your portfolio to make outsized returns. But there's a good argument to say that even a 20 stock portfolio is fairly concentrated. So anyway, why is this called the NAPS? This really stems from the card game Napoleon. It's an old name. But the nap hand in that game is a declaration that you can take all the tricks in the game. So it's only ever used when you've got very strong odds. And also it's got a nice analogy in that, you know, because it only takes a very short period of time, a year, you can sort of go napping. But anyway, nap hands are often seen, and the term is used a lot in horse racing, etc. There's a lot of links in this document, so if you download, and we'll make the link available, if you download some of these, if you click through to some of these articles, you can read the evolution of this process over time. This shows, I'm going to run you through some of the results of each year, because what happens is this portfolio is rebalanced once a year in January, but it could be any time in the year that it's rebalanced. But to date, I've been rebalancing it literally 1st of January every year. So in the first year, 2015, we saw almost 19 out of 20 winners in that year, which was quite a lucky set, I have to admit. But International Greetings especially had returned something like 150% over the year, with also some big winners in Dark Group, Adept Telecom, Character Group and Cohort. 2016 was a lot more moderate, and I introduced another rule in 2016 to never select two stocks from the same industry, as well as spreading across sectors. But you can see that although there was only half winners and half losers, the winners did do slightly better than the losers. And the important thing to point out is that the two biggest winners, or actually three of the biggest winners that year, Indivior, Drax and John Wood Group, were stocks that almost nobody wanted to buy at the time, because they were, most investors were quite turned off by the stories. But as you can see, this is not a foolproof system. You're going to buy, one would buy a fair share of losers. And what we've seen in 2017 is again a spread between the winners and the losers. What's been interesting is that these results are by June the 30th, but actually now we're in later July, and IQE, the top performer, has now actually almost gone up to 200% gain. Games Workshop has now more than doubled, and we're seeing some even stronger returns. So what we're tending to find across all three of these years is this kind of breakdown. So on the left, you can see that over the 3 years, we've picked 68% of the stocks have been winners, 31% have been losers. But on average, also the returns to winning stocks in this bar chart on the right show you that the winners have tended to gain a lot more than the losers have lost. And this is what generates all of the returns. So it's really, there's a statistical basis behind what's going on here. It's important to understand that this is a philosophy, it's not a prescription. And I'm going to be stressing this more and more throughout this presentation. And it's really a philosophy based on several key principles. And this is something, a sort of an easy way of understanding what's going on here. And I've put together these 4 rules or principles just to drive home this point. And we're going to be structuring most of the presentation around these principles. Firstly, the idea of managing the monkey. Now, this is the idea that we're all behaviorally flawed. We all suffer from behavioral biases, cognitive biases that tend to make us overconfident, influenced by the herd, and having sort of only paying attention to things that we already know about and stocks that we already know about. And we're also real suckers for narratives, suckers for a good story or a good theme. And the important point on this is to put rules in place to counter that. The second point is aligning with the factors that pay off in the market. I'm going to show you all about the quality, value, and momentum factors that are the basis of the stock ranks, which are some of the most enduring factors and payoffs in the stock market. Third idea is to give each stock a role, to diversify a portfolio. You could think of it as a sort of football team, of having a good defensive base, and then having more speculative shares on top, but also spreading your risk so that you have so that you don't have too much in one sector. But one of the very, very key points that I'll be going into a little bit of depth is the idea of rebalancing, keeping your balance. So over time, the stocks in a portfolio will drift, the prices will drift, the valuations will drift, and the rankings will drift. And what that means is that over time, a portfolio will tend to end up becoming averagely exposed to those factors. So what you have to do is rebalance a portfolio to keep it in line with the kind of factors that pay off in the market. So I'll be explaining this. Now, a lot of people use buy and hold investing. Personally, I think buy and hold is very good in certain market environments, but for the market environments we've been having, it does pay off a lot to have a rebalancing approach and profiting from these factor premiums. So just a little bit more on this key concept of managing the monkey. I've actually done big presentations at some of the big investor shows in the UK, where I've actually polled the audience live to actually look at their prevalence to overconfidence, inattentional blindness, narrative, authority bias, loss aversion, anchoring. You might not know what some of these ideas are, but if you watch this webinar at this link, you will get a very good idea of it. This is probably about a 40-minute presentation I did, and the camera's a bit jittery. But because there's live polling of the audience, you really see how people suffer from these flaws. And I talk about some of the ways that you can counter this. But the key way to counter it is to use a checklist or rules-based approach. Now, the important thing about a checklist is, when you're doing any process, you can easily forget something. So when we make decisions so much based on stories, you can actually forget something absolutely critical to look at. And in stock picking, this is very, very much the case. So using and building a checklist of things to look out for is so important. And in this NAPS process, you can think of this being a systematic approach that essentially is doing a lot of the checklist work for you in a way using the StockRank system. And also in the portfolio construction. And, if you think of pilots who are doing takeoff on a plane, or surgeons who are doing surgery in a theatre, they always use checklists because it actually minimizes the risk of catastrophe. And these can be in some situations, like flying planes or doing surgery in theatres, they can be life or death. But with your investments, this is one's future one is thinking about, and making terrible mistakes can cripple people forever. So I think it's very important to understand that systematic based ways of investing actually can limit the amount that we make these sorts of mistakes. And I think it's a great quote from James Montier, the famed equity analyst and now fund manager, whose writings were very influential on me after 2007. And he actually brought up some research which actually compared the use of quant models across about 50 different domains, all the way from analysing and predicting the prices of wines, or predicting the chance that, for example, a criminal might reoffend after he's been released from prison. And he showed that the evidence is clear. Quantitative models usually provide a ceiling from which experts detract performance rather than a floor on which they build performance, as we tend to overweight our own opinions relative to those of the models. And personally, in my investing, this has always been very much the case. And which is one of the reasons I am very, very happy to delegate my own investing process entirely to the StockRanks. Although, you have to make your own decisions on what you do. But I have found that actually when I do pick stocks, and I found it actually when a lot of people pick stocks from the StockRanks, they tend to pick the stocks that they think are going to be the better performers, which often aren't. And often it's surprising that often stocks that we don't even know about can be the ones that actually generate the lion's share of returns in portfolios. So I think this is a key point. The second idea is aligning with the payoffs. So if you're going to build a checklist to select shares with, you need to make sure it's constructed so that it aligns with those key drivers of return in the stock market. And I bang the drum about this a lot, and I probably get told off for repeating myself all the time to the point that it's slightly even boring. But there are three key factors in the stock market that really pay off. The two which I think are most powerful are the concept of value and the concept of momentum. We can all understand value. We can all understand the fact that, even if you go down to the market to go and buy, shoes or apples, or maybe not apples, it might have a worm in it, but cheap beats expensive. People are always on the lookout for a deal, but in the stock market, less expensive shares have a tendency to outperform more expensive shares. People overbuy expensive shares and they get scared of cheap shares, and it means that there is this great return to value investing. Now, many investors are value investors and they will very much understand this, but it's a real truth in the market. It's one of the key factors that pays off. If we actually, obviously, if you just go and buy cheap things, you might buy that rotten apple with a worm in it. So one of the key other balancing factors is quality, and the idea that quality companies beat junk companies in the market. Now, I know it seems like common sense, and I know I'm possibly, I don't want to teach grannies to suck eggs, etc. But profitable, cash generative, high margin companies have a tendency to beat speculative, capital consuming, always fundraising companies that promise future returns. And these two types of companies you can call quality or junk companies, and quality companies tend to outperform junk companies. The great irony is, though, that most private investors muck around in the speculative part of the market in the junky shares. Because why? Well, for example, an exploration company might promise to be drilling a well in the middle of the Atlantic Ocean where there are maybe 1 trillion barrels of oil. And this story is so compelling that people are willing to suspend their disbelief, go with the story, and hope. And what happens is that these kinds of companies, which are often blue sky, do tend to actually have to keep raising more and more and more and more capital. Early investors get diluted again and again and again, and it's not a pretty story. So balancing out quality and value, you can find good and cheap shares. And this is the kind of quality value is the kind of strategy that someone like Warren Buffett, the great investor in America, has pursued his entire life with ruthless, you could say he's been quite systematic about it. And his determination to always buy good cheap shares has made him one of the richest people in the world. The third part of this triumvirate is called momentum. And it's quite counterintuitive to a lot of private investors because they're always looking for shares that have knocked down in price. But actually, strong shares that are leading, that are going up and are at new highs and breaking out, tend to keep outperforming, whereas shares that are falling and are reaching new lows tend to keep falling. I'm talking about averages here, but this is one of the strongest forces and factors in the stock market. So here we have quality, value, and momentum. And you can think of these as being good, cheap, and improving shares. And I like to say that shares that I borrowed this phrase called super stocks from Professor Robert Haugen, who's one of the, sadly passed away a few years ago, but he is one of the great professors in this domain, who said, that basically you shouldn't be able to find good, cheap, improving shares. They should be more expensive. But actually, you find that the returns to good, cheap, improving shares are really, really wonderful, and he calls them super stocks. And we've borrowed that term on the Stockopedia site. You can think of the opposite as junk, expensive, and deteriorating or weak shares. And I like to call those sucker stocks. And the reason they're sucker stocks is people are still buying them. And you tend to find that private investors tend to buy more of them. And if you go and look at on the Stockopedia site, you'll see we have these labels. And some of the most popular shares are classified as what we call sucker stocks because they have poor exposure to these risk factors, quality, value, and momentum. And that makes them sucker stocks. Now, the important thing to see and understand on the Stockopedia site is that we've created and crafted this concept of the stock ranks to define quantitatively these three proven historical drivers of return. Now, we score what we actually do behind the scenes, and this is what makes this NAPS process so possible to be done in such a short period of time every year, is that every single day we are importing something like 40,000 shares, 40,000 companies' financial statements price histories, estimates data, all into a massive computational process that calculates, for example, in terms of value ratios, the P ratio, the price to book ratio, the earnings yield, the price to sales ratio, more and more. We've got dozens of these valuation factors. And we take 6 of them and we rank each of these very, very key 6 as a percentile rank across the whole universe. And then we basically bring all of them together into a composite value rank. Now, this value rank shows you the level of cheapness of a share. And we rank everything as a percentile between 0 and 100. So 100 is cheapest, 0 is most expensive. And you can see here, I've got some numbers here for the quality rank, the value rank, and the momentum rank. Each are between 0 and 100, where 100 is best. The quality rank is a combination of factors that analyze the quality of a company's franchise using long-term return on capital, long-term return on margins, long-term gross profitability, and more, as well as looking at the fundamental trend of the company using something called the F-score, as well as looking at key bankruptcy, earnings manipulation, risk factors. And these all go into a bundled composite we call the quality rank. And in momentum, we use both price momentum and earnings momentum. So these all come together into this composite, which then is again re-ranked across the whole market and equal weighted into the overall stock rank. So you can look at these factors individually or as a composite stock rank. And you can see here we've got 80. And these are published at the top right of every stock report. Now, long-term subscribers will know all this like the back of their hands, so I'm really sorry for reiterating this, but we do have a lot of newcomers on this webinar. So here you can see Games Workshop as an example. It's in the NAPS portfolio. It's actually just taken off again after this was printed, but it showed it has a stock rank of 95, and it's been doing very well this year. And you can see on this stock report that it's reasonably... it's getting more premiumly priced, so it's actually value rank of about 38, but it's not excessively expensive. The quality ratios are quite good and strong against its sector and the market as a whole, and the price is actually returning to, is recovering. And what that means is that you've got basically overall 3 factors, a very, very strong stock rank. So as I said, the stock rank goes from 0 to 100 best, and you can think of junk, expensive, weak shares at the bottom and good, cheap, strong shares at the top, and that's certainly what you'd see in something like Games Workshop. The overall performance of the stock ranks has been very stunning since we launched it. This is the UK performance to date, and it shows you sequentially, it shows you the performance of 90 plus ranked stocks in green, which have returned over 120% over almost 4.5 years. They've been doing about 20% annualized, whereas the bottom ranked shares have been doing very, very badly. So you can see that these measures do have some form, or have had some form of predictive qualities in the market over the last few years. Of course, the future may not be like the past, but these factors, although they don't necessarily outperform in every single year, over every 3-year period or so, historically, we've found that they do tend to outperform. So if the future is like the past, then one might expect the same thing to continue, but there are no guarantees. This chart shows you the hit rate of picking winners that I think is quite important to understand. On the right here, this is all the stock ranks put into different buckets of 0 to 10, 10 to 20, etc. And on the right here, you can see the 90 plus ranked shares, which have, and the blue part of each of these column charts shows you the number which were winners, and the red shows you the number that are losers. So even in 90 plus ranked shares, this is a bit of an older slide, but it does show the kind of key principle that a great proportion, even in the top ranked shares, will end up losers over a 12-month period, possibly 30%, 33% in certainly to date that's been the case, but I expect it might even be higher over time. But you can see that in higher ranked shares, they have tended to statistically be capable of finding more winners than lower ranked shares. And I think that's the key point. And that's certainly what we're trying to pick up on in the NAPS process. We have an understanding that quite a lot of shares will be losers, but with the statistical method, we should be able to pick a higher proportion of winners. One of the key things I always say is, why are high stock rank shares often underpriced? And I say that's predominantly because nobody likes buying them. We have a psychological aversion to buying cheap stocks or value stocks because they've often got problems and no one else is buying them. People often don't like buying good stocks because they find them too boring. People much prefer to go and find lottery ticket shares, which have much higher capability of doubling in a year. Most people don't get too bored if they think a share is going to go up 10% a year. And nobody likes buying leading stocks or momentum stocks because it's scary to buy them at new highs. So I think, and I believe behaviorally, this is the key reason why these sorts of strategies do actually outperform. This is an old webinar, but it does go into a bit more depth into the construction of the stock ranks. I promise to refresh it at some point. And you can go and find it at that link, so if you want more information. So the third key concept I wanted to go into is this idea of giving each stock a role, or diversification. It really is the only free lunch in investing. And I want to talk a little bit about diversifying a portfolio across sectors, size groups and styles. And I told you that earlier. I said in the NAPS process, certainly to begin with, I was using 2 stocks, 2 by 2 by 2 from each sector. And I want to show you in a little while how I'm going to construct a portfolio on the site. But I want to give you some background that uses, and also talks a little bit about some of the other tools that we've got on the website. Before I talk to you about classifications, it must be stressed that it must be discussed how many stocks to have in a portfolio. Because you often find some of the gurus like Warren Buffett or Bill O'Neill or even Jim Slater will push this idea that diversification is a hedge for ignorance. So they often promote having really concentrated portfolios, like often even 8 to 10 stocks or 5 stocks. Bill O'Neill often says own 5 stocks. And personally, I believe that these are some of the most dangerous quotes in finance. As I said earlier, I used to run a 5-stock portfolio, and it's very, very easy to get overconfident on those shares. And I've now completely changed my thinking on this because I appreciate that factors, these risk factors that actually you can earn in the stock market, are actually better earned by investing a little bit more broadly. Now, of course, concentration of a portfolio for a private investor, for some reason they all think concentrating a portfolio means owning 5 stocks. But whereas for a fund manager, a concentrated portfolio would be more like 30 stocks. So it's all a matter of perspective. But anyway, these upcoming slides are quite interesting. These again are old slides, but they really show you the key principle here. If you owned a 5-stock portfolio and you were buying, say, 90 plus StockRank stocks, you would find a kind of random distribution of outcomes. So let's say we took the list of 90 plus ranked stocks on the StockRank site and we threw darts at them 5 times and picked 5 shares and then kept doing, and then tracked the performance and then did it again and again and again and again. You would see a distribution of outcomes a bit like this chart. So you can see that there's no, you might do very, very well, you might do very badly. There's no, as we know, there could be a lot of losers in that set. Maybe a third of the stocks would be losers. So in 5-stock portfolios, there's a kind of randomness of outcome. But if you start adding more shares to a portfolio, like 15 stocks, you start seeing less of a random distribution. And if you get up to like 20, 25 stocks, you start seeing a much tighter, more sort of predictable outcome to a portfolio. In a way, if you think of, like, let's take the UK market, if you had 170 stocks in the top 90 plus bucket, if you to get a sample that is quite indicative of the return of the whole 170 stocks, I find sort of 20, 25 or even 30 shares is about right. It actually means that it minimizes the chance of deep underperformance compared to that 170 stock benchmark. So I think this is key, and this is quite an important point, and there's bags of academic research that backs up this idea. I like this from Joel Greenblatt, who wrote a fantastic book called The Little Book That Beats the Market. It's only about 120 pages long, and I do recommend it. And it really pushes a systematic strategy based on quality and value. He says if you're doing a limited amount of work on individual stocks or no work at all, like most investors, diversifying with 20 or 30 magic formula stocks, which is his strategy, is most definitely the right plan for you. And so even people like Joel Greenblatt, who actually made his fortune as a professional investor, investing in about 8 stocks, he now actually has his own fund, which now invests on a much more diversified basis. Now, I wanted to show you this because this actually drives home some of this idea. I actually ran a test. I said to myself, right, I want to get a bit more basis for the fact that a 20 stock portfolio actually does well. So what I did is I compared this 2 by 2 by 2 approach in buying 2 stocks in each sector in the 20 stock portfolio, and compared it with buying the top ranked stock in each sector in this red line. Now, as you can see, the 10 stock portfolio has been a lot more volatile. It's been a bit hairier. It's outperformed at times. But, this year, certainly, there's been a significant underperformance. And that underperformance has actually continued. It's even more diverse now. And year to date, this portfolio is actually down, which is well below the return of the benchmark on the grey line here, the FTSE All Share. And I think this is a key point. Yes, the risk one takes in having a concentrated portfolio is that you actually end up with one of those randomized poor sets of shares. If you want to basically earn these quality, value, momentum premiums in the market, it's better to cast a wider net. Now, taking it a little bit further, obviously, if you're going to buy a 20 plus stock portfolio and you don't have much capital, it can be very, very expensive. I put together this spreadsheet that you can go and look at this link, which uses a short link for Stockopedia, stk.pe/folio breadth. And you can see here portfolio size on this horizontal axis, which goes from 5,000 up to £100,000 in portfolio size, and the number of stocks in the portfolio from 1 to 50. And if you look there, you can see that a 20 stock portfolio becomes, with some presumptions about, for example, the amount that you turn a portfolio over each year, etc. At what point it becomes sort of equivalent or better than actually owning a fund. And I think it's, if you've got 20 grand plus, you're okay running a diversified portfolio. If you have like 5 or 10 grand, it's much more expensive, and one might want to either own less stocks or potentially back it up with some funds as well. But I personally also believe there is nothing like learning with your own capital. And most people actually come to investing, I believe, the wrong way. They start picking stocks when I think they should actually use a very systematic approach first, and then learn the idiosyncrasies of picking individual stocks themselves. But you do learn so fast when you're actually putting your own capital to work. So I never want to put anyone off investing, but I would say that it's very expensive if you don't have too much capital. Diversification. So I wanted to talk about, firstly, sectors and the sector classifications, as well as other approaches to diversifying. So there are many ways to diversify a portfolio. Sector diversification is one of the quickest and easiest ways to do it, but also diversifying across size is another good idea. There's a size effect in the stock market, which potentially small caps outperform large caps. There is disagreement as to whether this is genuinely true. Certainly in the short term and in bull markets, you tend to find small caps do very well. But even at the moment, you're seeing some of those mega large stocks in America, like they're called FANG stocks, Facebook, Amazon, Apple, Netflix, Google, doing amazingly well. So diversifying across size is a very sensible strategy, and something I now do in the NAPS portfolio. We've also now released onto the Stockopedia website some risk ratings, which classify stocks for their volatility. Now, over the long term, conservative or low volatility shares tend to outperform high volatility shares. So balancing your portfolio across some of these risk ratings is also a sensible idea for someone who wants to build an all-weather portfolio, and it's something I've introduced recently into the NAPS, and I'll be talking about that a little more. You can also diversify across styles and also across regions. There's plenty of research that actually suggests that diversifying across regions may be even better than diversifying across sectors. But ultimately, you can't. It's hard to do. To diversify a portfolio over more than 1 or 2 degrees of freedom. It gets increasingly difficult to do. So, choosing how you'd like to diversify and managing your risk is a very, very key thing to do. Just to quickly clarify on the sector classification on Stockopedia, we use something called the Thomson Reuters Business Classification Schema, and we publish two parts of this schema. We published the top level 10 economic sectors that I'll be focused on, and also the 54 industry groups. Each sector has multiple industry groups in it. And in the NAPS, I've tended to choose 2 stocks from each sector and tried to ensure there's only 1 from each industry group. So do explore the sector tools on the site, which are available at that link. Now, again, looking at the performance of the NAPS, some would say, why bother diversifying across sectors? Because they always say to me, if you try and force a portfolio to diversify across sectors, you end up with lower ranking stocks. You end up with stocks that, ironically, are less exposed to those key risk factors, quality, value, and momentum. And they say why. And I think this chart shows you why quite clearly. This second chart here is the green line that shows you the top 20 shares with the same market cap and size filters, but excluding any sector diversification. And you can see how this sector diversified portfolio is actually somehow, and perhaps it's luck, but it has performed a lot more strongly. And what happens here is that if you are in the top 20 by StockRank, you could actually end up only investing in just a few sectors. And those could be sectors which are possibly in vogue because they might give them higher momentum rankings. But it also means that you're excluding sectors which actually more generally tend to be at higher valuations. And an example is the healthcare sector, which tends to have much less high ranking shares because often healthcare stocks are very much in demand, which makes them priced at a premium and makes their value rank a little bit lower. So if you are using just the StockRank or just a scoring system, for scoring stocks, you could find that you're actually excluding some of the best performing shares in the market. And this is an important point to stress. So I've actually done plenty of research into the performance of the ranks across sectors, and it's been quite stunning, some of the results across all the sectors. So although historically I've actually possibly put too much of this portfolio in utilities and financials, which have underperformed, it's actually been a very, very sound strategy. I don't think there's any reason to be neurotic about doing this like a kind of Noah's Ark of investing. You don't need to sort of go and neurotically pick 2 by 2 by 2 from each sector, but actually ensuring there is a reasonable spread across 6 or more sectors, I think, is a very sensible idea, because it may ensure that you have defensive stocks as well as cyclical stocks, and it's a key point. I could go on all day about this stuff, I really could, and I'm planning on doing a course on this topic, which is a lot longer than an hour, but that needs to be done. Anyway, if you want to learn about some of the kind of more advanced methods of diversification and learn about the risk and style factors on the site, please do look at this webinar. I'm actually really proud of the research that we did into this and some of the solutions that we've created. If you're on the Stockopedia site, under the name of the stock, you will find some labels, such as on Tesla here, you can see it says Adventurous Large Cap Momentum Trap. And you can go in and learn about the 5 different risk ratings and the 9 different styles that we have on the site. And I think there's some great ideas there for diversifying your portfolio. So please do go and look at it. And in a minute, I'm going to show you the StockRank portal where I do a lot of my portfolio construction. Now, the last point, I get a lot of questions on rebalancing, and I wanted to just go into this a little bit more deeply. I want to show you the reasons why rebalancing is so important. Okay, firstly, the first thing I wanted to say is position sizing, because ultimately you've got to buy a certain amount of each stock if you're building a stock portfolio. Certainly, some of the questions I get are things like, should I buy more in my favorite positions, or should I use mean variance optimization or some kind of risk weighting? Now, there's a lot of complicated ways, a lot of complicated formulas like the Kelly formula, mean variance optimization, etc., etc. But I think I read a lot of a chap called Gerd Gigerenzer, and he made me aware that Harry Markowitz, who invented mean variance optimization, and so I don't want to lose you, you don't need to know about mean variance optimization, but Harry Markowitz, I think he won a bunch of prizes for his work into efficient portfolios, and even he used equal weighted portfolio because it was too much work for him to do it any other way. So one of the key points is that if you're in an uncertain situation with lots of alternatives like the stock market, to avoid overconfidence, it's worth keeping it simple. And equally weighting a portfolio is a very, very good way of doing things. So I personally, that's what I do. And although I do have some ideas for more advanced tools to put on the website, at the moment I recommend it. And equal weighting a portfolio is very simple. You know, I know most people know this like the back of their hand, but if you've got a 100 grand portfolio and there are 20 positions in it, you just divide the portfolio size by the number of positions and you'll come up with a weight. And that's how much you should buy in nominal value of each share. Now, why does rebalancing matter? And I said it earlier, but the key thing is over time, share prices drift, fundamentals drift, and estimates change. And that means that the quality, value, and momentum factors every stock are exposed to will drift. So the exposure of every stock to those key return drivers drifts. And, you know, company will come out with new results, or the share price will move a lot, and the valuation will change. And this is a really key thing to understand. And you're targeting these key return drivers in this kind of strategy. And this shows you actually the NAPS portfolio. On the left, this shows you all the 20 stock positions of the NAPS portfolio in January of this year. And it shows you the stock rank on a vertical axis. So you can see that all the stocks in the portfolio were ranked between probably about 80 and 100, with a bit of a spread. But, you know, you're talking about an average rank probably around 93, 94, something like that. But by July of this year, many of the ranks had fallen considerably. One below 50, and many between 50 and 60. And that meant that the average ranking had fallen more to about 75. Now, it doesn't mean that you have to sort of, you know, throw the baby out the bathwater and do a full rebalance or anything like that. But this stresses that over time, stock portfolios will tend to average. So if you left this for a long time, those ranks would drift again even more, and possibly over time you'd end up with a portfolio that was you know, not really as exposed to these key driving factors. So the thing about rebalancing is at a certain point, possibly once a year, possibly once every 6 months, possibly once every 2 years, depending on your personal situation and preference. Rebalancing a portfolio is a very, very good idea. Now, of course, Warren Buffett would say hold forever, and he's right. In some regards, if you are in a taxable account. You know, if you have to pay capital gains taxes and you're going to crystallize too many gains, then it's possibly worth thinking about buying a longer term strategy that focuses on super high quality businesses that you may never have to rebalance. But if you're trying to earn some of these other premiums like momentum and value, it makes sense to rebalance. And I would say that most people these days are investing in tax efficient accounts like ISAs and SIPs, where capital gains tax is not a consideration, and therefore actually rebalancing, the cost of rebalancing is much less. So I think that's a key point. This just shows you, using one of the tools on the StockRank website, for example, what's happened year to date. And you can see here that two or three of the positions like IQE, Games Workshop, have grown considerably. The weighting is on this horizontal axis, and you can see the largest bar here is IQE, which is now 12.3%. In fact, it's even more now. And at some point, this would become too much of a size in the portfolio, and people might want to shave those position sizes down. Similarly, there's been two stocks, Petrofac and Quarto, which have actually fallen a lot. And so you can see that over time, these position sizes drifts a lot. Now, that's not a massive issue in a portfolio, but you know, it is something that's worth bringing into line every now and then. Now, I don't think there's any point in being neurotic about it. If one is rebalancing a portfolio, you've got to try and minimize the costs. And some people, and I'll show you some of the ways that the community who use this sort of strategy do this differently. Some people take their discretion in rebalancing. There's not really a set way of doing this. And I want to explain the costs of this right now. So, but the point is, when and how do you rebalance a portfolio? And there's two ways of doing it. One is based on time. So, for example, on a fixed schedule, once per year, or doing rebalancing a quarter of the portfolio every quarter, or rebalancing a portfolio based on thresholds. Now, that might be rebalancing based on, as we saw in the previous slide, position weights changing, stock ranks changing, or potentially even classifications changing. Some people also rebalance in a way based because they use stop losses in their portfolio. So the important thing is to have a strategy and try and stick to it. As I said, you can spend a lot of time every year, as little time as you like, on a portfolio strategy like this. But some people like to have more management and like to spend more time crafting their portfolio through the year, a bit like a gardener weeding in the garden. Now, if you've got non-performers like Petrofac and Quarto, there is, of course, an opportunity cost to holding losers. So some people like to cut the losers and go and reinvest that into better performing shares or even higher ranking shares. And I think that's another sensible approach to rebalancing. So for the NAPS portfolio that I've written about every year, I'm actually using quite a brutal annual rebalance, which is a full rebalance once a year. And that triggers a lot more cost. And I want to talk about costs in a moment. Time-based, and really the NAPS have been done on a time-based schedule once every January. Some people do it semi-annually, but that does trigger a lot more cost. The more frequent your rebalancing schedule, potentially the more return, but the higher the cost. I've found that the costs and so the greater returns do not quite offset the costs of greater and more frequent rebalancing. So that's worth bearing in mind. Frequency of rebalancing often depends on account tax status, like I said. Portfolio size, as large accounts can trade more and more efficiently because the commission tends to be, for private investors, fixed. So if you're paying £10 a trade or less, if you've got a very big account, that's not going to be very much. Whereas if you've got a very small account, it's a lot more. But also the frequency should depend on the frictional trading costs. And by that I mean small caps or micro caps, which have got wide spreads, are more expensive to rebalance because of the spread. So bear that in mind. If you're investing in large caps in a tax efficient account and you've got a lot of money, rebalancing regularly is probably not an issue because it won't trigger too much cost. There we go. How do you minimize the costs of rebalancing? Now, if we just do some quick sums, and you can think of the costs of buying a share really are based on these three main factors. The commission that you pay to the broker, which at the moment is around on average £12 a share in the UK, which I think is scandalous. The bid-ask spread, which is possibly on average, let's call it 1%. It certainly was for the NAPS portfolio this year, but it could be much less in large caps. It could be much more in smaller caps. But on average, it was 1%. And in the UK anyway, we have this nasty tax called stamp duty. And this is 0.5% that you pay on purchases, not in spread betting accounts, but certainly if you're buying genuine shares. So if you're going to buy a 20 position portfolio, that's £240 plus 1.5%. Now, of course, if you're selling shares too, you may have to you have to pay the spread too. So rebalancing can cost, if you're doing a full rebalance, can cost quite a bit. Obviously, we've been seeing historically 25% a year returns, which I don't expect. I must make this clear. I don't expect to see 25% years forever. I would love it if there were, but if I did, I would be Warren Buffett at the end of it. Now, I don't believe that it will continue forever. I've always been hoping for more than 12-15% returns annually from this strategy, but it's going very, very well at the moment. But if there's a big correction, it may not happen. But I think you can see that, even around the kind of 2% a year mark, it's a headwind, but it's not overcomable by the extra returns in the market. So personally, I believe annual rebalancing is okay for most private investors, but I think it's worth using the risk discretion. What you are trying to do is maintain an exposure to these factor drivers of return, quality, value, and momentum. So if there's a very high ranked share that's still in the portfolio that doesn't qualify for the rules, there's no reason to rebalance it and sell it to put another one in if you still think it's perfectly good company. So personally, I think using some discretion to keep costs down is probably wise. But I think also looking at the cost of rebalancing and thinking, oh, I can't take on that cost, is perhaps a bias which can lead to lower returns. I personally look at the cost of rebalancing as a bit like the costs of running a business. You know, if you're running a portfolio, you can think of it as a business, and one of the costs of that business is the transaction cost to keep it fresh, keep your inventory fresh, and keep really good stocks on the shelves, which are kind of going to be sold in the market. I think that's a good way of thinking about the stock market. So anyway, certainly the way some people are doing it is they're replacing big ranking movers and replacing poor performers, or rebalancing at position weight thresholds if you're doing all this on a threshold-based rebalancing. Anyway, so as I said, there's time-based and there's threshold-based rebalancing, and ultimately it's about using one's discretion to choose the right approach. Important to say this from Andrew Ang, rebalancing is the simplest and yet one of the most powerful ways of buying low and selling high. And he says at the other side of a strategy that buys low and sells high, somebody is selling low and buying high, which is the crazy thing to do. Certainly there is, I do get quite a lot of feedback from people saying, you know, why would you want to buy more of the losers and sell the winners? That's opposite to running winners and selling losers. And I think one of the important things to say is actually losing stocks in a portfolio strategy like this, that the rank will tend to fall. And so you will tend to find that they will become candidates for sale rather than candidates for repurchase. So I would say that this keeps you out of, it actually helps you cut losing stocks. But certainly in something like this rebalancing strategy, you can keep running your winners if you wish. You can use your discretion. Personally, I clip the winners. I tend to have a tolerance. Certainly if in my own portfolio, I tend to also sell the winners, but I don't tend to sell them all. Because this strategy actually is a way of buying low and selling high, and it's a way of systematically doing it. I know plenty of people who run their winners a lot longer using this strategy, and it works very, very well for them. Certainly over the course of this year, we're seeing IQE, which is one of the big winners, continuing to run, and it's now up almost 200% for the year. So that will not be clipped back to size until next January. So here's a slide that shows you all those portfolios that I've shown you before. And now I wanted to go into a little bit about building a portfolio. I just wanted to see if there's anything else I wanted to talk about before I go out. Yeah, I wanted to quickly show you, before I go and show you how I do this on the site. These are some of the community results. So we've got a couple of very vocal subscribers, one called Mechanical Bull, who started a StockRanks portfolio before I started publishing it, or very soon after we started publishing the StockRanks. And he's been doing 25% annualized over 3 years, so it's worth looking up there. And I know that Ian, known as Grinder Trader on the site, is running a StockRanks portfolio in tandem with his discretionary portfolio. And I believe the last time I looked, the StockRanks portfolio was outperforming. And we've had dozens or possibly hundreds of people using this NAPS process on their investing. And I did a poll in January which showed they were averaging 14% annualized returns. And I presume they would be doing even better because this year's done even better for this strategy. Mostly UK, 16% European, 11% USA. A quarter of those investors are using stop losses. And people are using between 8 and 42 stocks in each of their portfolios. So this is important to understand that these are principles, and people are applying this NAP strategy in lots of different ways. And using one's discretion to build your own, something that fits with your psychology, fits with your approach, fits with your portfolio size, tax status, etc., is a great way of going about. 2/3 are using even sector distribution, 1/3 are uneven, and a quarter are using annual rebalancing, and quite a lot, probably 50%, are using ad hoc rebalancing. There's a lot of variations in buy rules, so while I'll be showing you something which is very much based on the stock ranks, we do have a lot of income investors who are adding additional criteria, such as ensuring that their strategy includes a high dividend yield. Some people don't use, for example, momentum. Some people don't use value. Some people use the QM or quality of momentum rank instead of the overall stock rank. Some aren't buying stocks with high debt. Great idea. So others are using other factors like the PEG ratio, the ROCE, to ensure that they get shares that they're more comfortable with. So there's a huge variation on buy rules. There's also a variation in terms of diversification. So there's one guy who says if there's no 90 plus UK stocks in a sector, he uses other regions to ensure that he's got 2 by 2 in each sector. Another who ignores utilities and financials completely, because often financials don't rank quite so well, or they are more idiosyncratic, and utilities have all their own, utilities often don't perform quite as well as others. Some use other factors to diversify instead of sector, as I went into earlier. There's also lots of variations where people use stop losses. Like I was saying, a lot of people are using these threshold approaches to rebalancing, such as rigorously applying a 7 to 10% stop loss. That personally, I would find a 10% stop loss too tight, but works for some people. Some people selling immediately when a stock rank falls below 80, and you can set alerts on your positions to trigger this kind of thing. Some people use a 20% stop loss, etc. So there's one guy here who says if he'd included a stop loss of say 10%, I would have made a small profit so far rather than a loss. So certainly some people seeing the benefits of using stop losses. Also, keeping on this theme, some people rebalancing on major moves or when a price reaches a target or when there's greater than a 40% gain. And the last thing I wanted to talk about was about the emotional breaks that people have. There's a great book called Behavioral Portfolio Management by a guy called Thomas Howard that I hugely think I really, really enjoyed this book. And he talks about releasing one's emotional breaks. He says that people have people have these kind of emotional breaks that stop them from generating wealth. And a couple of people have sort of picked up on this, saying even in a mechanical portfolio, I still get emotional attachment to shares. E.g. IG Design, which has been a large winner in my portfolio, it met all my sell rules, didn't act on it. Emotional restraint mattering. This guy sold Indivior in breach of his own rules after it had declined in value, and then he missed out on a prolonged upswing. As I said, in 2016, Indivior was the top performer. And other people have said they find it very, very, very difficult to buy shares that they don't know or they've never heard of or that look odd. But something that Thomas Howard said in his book is that actually he invests completely blind now. He actually hides the names of every stock that he's buying in a portfolio, which is certainly an interesting approach. And I actually made me think that maybe we should have a filter on an option on the website for doing that. And I've often found this really interesting when I've presented at conferences and I've shown what a stock report which had a 99 stock rank, and I showed that it was I blurred out the company name and I watched the reaction of the audience when I revealed it, and I revealed it to be Barrett Developments. And of course, after the financial crisis, when nobody wanted to own house builders, we all had a kind of emotional disagreement with house building stocks, and actually it's turned out to be one of the very top winners. So I think there's something in this. Anyway, very important to know. Okay, look, I'm just going to show you some things on the website and ways to actually do this. I'm going to go up to the Ranks tab, and I'm going to just show you the StockRanks portal. So if you're on the site, you can go to Ranks portal by hovering over Ranks and clicking Top Stock Ranks, and you see here a list of shares. And this, I'm focusing on the UK here. So if you're an international subscriber, you can look at your own markets or Australia, Asia, America, or even add on those regions to your own subscription by going up here and going subscription upgrades. Now you can see here the stock rank. The default is to list all the shares in order of descending stock rank, and you can see some of the top ones here, and they're kind of spread across a few different sectors. Now, like I was saying earlier, you can see there's a lot of industrials which are ranking highly. So if you were buying the top 10 or top 20 shares, it would be quite concentrated in some sectors. So what we've got here on the left is a bunch of classification filters, and so if we wanted to go and find 2 stocks in each sector, we can easily go and click sectors. And you can see that each of 10 sectors here, click one of these, energy, and there we can find the top ranked shares in this sector. Now you can see here immediately the first issue that I was talking about. For example, if we have a cutoff in the NAPS strategy of not buying any shares with a less than 50 million market cap, you're going to have to start down here. Serica Energy and Petrofac, which are both 70 ranked shares. That's not necessarily a problem, but I'm going to use a little bit of discretion and add some others too. Now, but what you can do is select a couple of shares, add to portfolio, and I've actually set up a portfolio here and go add to the NAPS webinar portfolio. This will take you away from that Ranks portal and into the portfolio, which is essentially a watch list at this stage. And I've put 2 energy stocks in there. Now, as we go, you can actually go down and do 2 by 2 by 2 in every sector. And if you actually hold down, you click these check boxes and do this. If you actually hold down your command or control key on a PC or command key on a Mac, it will actually open that in another window, you see? So that we keep that window open. And I'm just going to keep doing this because I'm going to show you the very simple approach. This is the simple approach that doesn't take any form of other diversification into account. And I'm going to keep doing that for each one, just adding to the portfolio, and 2 by 2 by 2 in each sector. Always trying to ensure they're above a 50 million market cap, of course. It won't take me long to do this, promise you that. Let's look at that one and that one. I'm going to do the next healthcare now. And there we can see, you know, there aren't very many healthcare stocks with a high stock rank. So if you're too brutal, you might miss out on a sector which has actually historically done rather well, because these stocks tend to have a higher valuation. Actually, just point out, there's Bioventix, which has been one of the great winners for subscribers in recent years. So I'm going to add this, and then I'm going to go to technology, do the same. And here we can see amino technologies. These two have got, they're too small for my rule, so therefore I'm not adding them. Add them to the NAPS portfolio. Telecoms, BT. It was in the first set of NAPS, it did brilliantly, and then it actually got booted out. Oh, it's amazing. Vodafone's actually there now. It got booted out after the first year, after it was one of the top performers, and then it actually had a terrible decline. But now it's ranking well again. Of course, BT's had all kinds of accounting issues, etc. So there you go. Now I've done 2 by 2 by 2 in each sector. I'm just going to close some of these tabs because they're all duplicative. And here we can see, I'm going to get rid of that notification. And here we can see 20 stocks in a portfolio, 2 by 2 by 2 in each sector. There we can see them. Now, that's all fair and well. And actually, that is a very straightforward way of doing a portfolio like this. But you can see this is the quote screen in the portfolio. And you can find your portfolios up here. So you could click NAPS Portfolio Webinar there. What about if we wanted to diversify across in a different way? And if you click one of these other tabs, I've set up this ranks tab, and I want to show you this. Click ranks, and you can see all the stock ranks. And this is quite instructive. You can see, yes, 2 stocks here with a low stock rank, Serica and Centrica, 75 and 78, and energy and utilities. And all the others quite sort of high ranking. And I've actually set this table up slightly differently so that I've got the risk rating and the style and the sector. I want to bring in the industry group too. So what I'm actually going to do, let me show you. You can edit these tables, and you can edit the columns in the table. So I'm going to click ranks here, and I'm actually going to get rid of the quality, value, and momentum rank, and I'm going to add from profile, industry group, there. And I think that's all I need at the moment. So I click Save Changes, and you can see that's brought in the industry group too. Now, what you can have a look at, analyze using this sort of table, is the distribution across different classifications: risk rating, style, sector, industry group. And you could even do this based on region as well. But I'm just focusing on the UK, so we'll look at this. And you can see here, if I sort by risk rating, if you know the risk ratings and if you've watched that webinar, you'll see that there are 6 stocks that are conservative or balanced, whereas that means there are 14 stocks that are adventurous or speculative, and 1 highly speculative. And this means this is certainly a riskier or more volatile set of shares, and some people might be uncomfortable with that. So if one's uncomfortable with that, you can actually go back to the ranks portal and select stocks with certain other types of risk ratings. So I'm just going to do that. Go back here, and let me just go back and go and click risk conservative. And sorry, I'm actually going to reset all of these filters and start again. Hang on a minute. Go to here, and I'm going to go to risk rating conservative, and we can see there they are. Actually, there's quite a lot of 90+ rank conservative shares that might be of interest. Now, some of these are already in here. we can see that Jersey Electricity, Vodafone and Caretech are already in here. But I'm just going to bring in a couple of others, just in a couple of sectors, just so that I can, have them there, and so that then I can actually sort of select a bit more effectively. So I'll add them to there. And if we go back to this portfolio and back to the ranks tab, you can see, and we sort it by risk rating, and we could do the same thing again on the balanced sets of shares and go and select shares in possibly other sectors as well, which are lower volatility. And I might be the sort of person who doesn't like having highly speculative shares in my portfolio, so I'm actually going to remove Serica Energy from the portfolio, or from the watch list in the energy sector, and I can go and delete that stock. Okay, and that could mean, because I made a space there for another energy stock, I could go back and I could click in the sector energy, and I could go and look for lower risk energy stocks, for example. Now there's NWF. It's been in the portfolio again. It's only a 76 rank, but if I really want to have exposure to, there's no conservative stocks. If I really want to have exposure to the energy sector, I could select that. So I can just select it, add it to NAPS Portfolio Webinar, and you can see this is a way that you could craft a portfolio which has the kind of spread of risks one is considering. Now obviously I added a few extra conservative shares across a bunch of different sectors. So I could again go back and look at the sector diversification, and I could decide, looking at, say I've got Bloomsbury here, I could decide to remove one of these two. Now if I'm looking at sectors, I can see that there's two house builders here, Berkeley Group and Persimmon. They're both adventurous. To be honest, they're pretty similar, these stocks, so I'm going to remove one of these consumer cyclicals. Let's go and, for example, get rid of Persimmon or BKG. They're both large caps, so I'm not bothered. I'm going to remove one of those. And in this way, you can see I'm consciously trying to sort of craft a balanced portfolio across risk, across sectors, which actually makes sense. And one can do this one could spend all day doing this. You could be very comfortable with the 2x2x2 in each sector approach, or you can craft it in a way that actually provides a greater balance across risk ratings. And if you got and you click on this allocation tab, you can actually then go and see your sector diversification here spread across all the different sectors. I'm actually going to be improving this allocation tab very shortly to include the spread across risk ratings and across style ratings. So this will actually be something that you can actually use consciously to craft that portfolio. But I think this gives you a bit of an overview. You can see here the kind of style ratings. Mostly these are super stocks. There's a lot of people on Stockopedia who prefer the high flyer classification. This set has not chosen any high flyers, so you can go back to the StockRanks portal, and if you want to diversify across style, you can of course go style and choose, for example, high flyers. High flyers tend to have lower ranks, but they perform very, very, very well as a set. And this is the sort of way that you can go and find them. And that's really it in a nutshell. I haven't gone to the point where I've got this down to a 20 stock portfolio, but you can see the process that you might go into. These tables are all editable, etc. There's something I wanted to show you though about actually managing a portfolio like this. And if I go to this NAPS webinar portfolio, sorry, if I go to actually my NAPS portfolio, I want to show you, this is the NAPS for the year. We can see it's actually, and I want to show you how the ranks have drifted over time. So again, click that ranks tab, and here we can see how the stock ranks changed. DRAX is now ranked as 42, Quarter at 50. You've got almost half the portfolio with a low stock rank. So these were all high ranking shares to begin with, and they've now drifted down over time. But one thing a lot of people don't know about, and these kind of views can help you identify the sort of shares which might be worth rebalancing. And certainly in the holdings tab, which is the default tab, you can then go and look at the gain, and you go to the percentage gain, and quickly identify those that have done really badly. Because there's been no stop loss, Petrofac and Quarto have been allowed to fall about 50%, which is way higher than I would like. But if you had a stop loss, you might be able to cut them. Some people with a 10 or 20% cut stop loss would be cutting these losers and trying to find new candidates to actually put in into the portfolio. But the thing I wanted to show you is this little known feature up here, top right of this view bar. Click it, and you get this fabulous view I call the bubble charts. and I want to explain it very quickly. You've got the value rank on the bottom axis, and you've got the quality rank from junk to good, value rank from expensive to cheap, and you've got each bubble shows you the size of each position. And you can see here for QV, quality and value, IQE is moving out of this good cheap zone into the expensive junk zone, the sort of zone where you find underperformers. It's done because it's done so well, it's got very expensive. But also these tabs up here, you can look at, this is just quality and value, but you could also look, for example, at quality versus momentum. And these are, showing you the quality rank and the momentum rank on the same bubble chart. And here you might find different shares like Drax, Exelon, Quarto, and certainly some of these shares I would be looking to get rid of. A lot of shares still up in that top right area where you find good leading stocks or lagging junk stocks, and some of them are moving towards lagging junk stocks, which are the sorts which I would be looking to get rid of. So if you're using a threshold base or a discretionary way of rebalancing, these bubble charts are very, very helpful, and so are the table views. Really, that's all I wanted to go into. We're hoping to build actual rebalancing tools on the site, position sizing tools which can help you construct the portfolios yourselves, but at the moment you have to do the calculations yourself. And I wanted to just say, if anyone is not yet a subscriber, do go and take a look. Go to this URL and have a look. There's a 14-day free trial, and I hope you get a lot of good use out of it. It's a very inexpensive way to actually do very well in the stock market. So thank you very much for listening. That's all I wanted to go into. Wishing you all the best and best of luck. Very happy to take questions on comments on any of the blogs on the site. All the best.